everyone. I sat down for a morning meeting this week with Senior Loan Advisor at Guild Mortgage, Jesse Tenenbaum. Jesse is one of those guys who lives and breathes financial education and has great advice for people interested in financial independence. Listen in to hear about a loan product he has that rivals the military's VA program, but that's only available to first responders. Hope you guys enjoy it. Hey, Jesse, welcome to the bullpen. Thanks for meeting me.
My pleasure. Glad to be here.
Yeah, awesome. So we've been experiencing some unprecedented times here with the coronavirus and the global pandemic and how that's affected our economy. How have you seen that shaping what you do in your line of work?
It's a challenging time for a lot of reasons. We hit historic low interest rates on February 28th. And, to put that in perspective, there's about 15 trillion of mortgages in America right now. 10 trillion, so 2/3 of those mortgages when we hit 3% could be refinanced. My business, everyone together, if we all were unaffected, working, as high purpose and high output as we could not even catch up to that production in 5 years. So we have about a 2 trillion capacity per year. So the demand was so much greater than the supply. So everybody applied to refinance. Then COVID, it didn't start in February, but it started to escalate. The stay-at-home orders and things like that happened. So you started to see your first round of furloughs. You saw people lose their assets in the stock market. So there was a massive burden on the liquidity market, on the mortgage market, that we're almost just starting to get through. So there was utter madness in the lending because it was a combination of those two factors. But in terms of the real estate market, it has stayed pretty strong in San Diego. There was enough of a buyer pool, enough of a demand where people that were either fearful and they stopped looking for a house, or they were one that lost their job or lost their assets. There was still enough people to, when there was even a small decrease in homes being listed, there was enough demand. So we have seen a really good purchase market even in the middle of all this chaos. So clients are not getting 10, 15% reductions on their houses. They're not, but they are getting homes locked down and purchased that they would never have had a chance in a market where there's more competition. So I'm a big believer of Warren Buffett. He's always fearful when others are greedy and greedy when others are fearful. So at the start of this, there was really an opportunity for clients that were level-headed, that understood and weren't really at risk to lose assets or their income, that they were able to get a house, lock it down, tie it up, and actually close in the middle of all this drama. So it's an incredibly unprecedented situation, but I'm always an optimist and I always look for the opportunity, whether it's a good market or a bad market. So it's a really unique time right now.
And it seems like if you are prepared and you aren't fearful like everybody else, there's some opportunities to really do some good in this sort of short, medium, and long term. Does that sound about right?
Yeah, it's all supply and demand. And right now, the supply is nowhere near as much as the demand. We call that a seller's market, the advantage to the seller versus the buyer. So when there's any type of supplemental help to a buyer, and that could be literally as easy as some people are just no longer looking because they're scared or because they couldn't, they lost their job, they lost their money. That is an advantage. And even though it could be small, when you realize it, you are going to, get a property that you would not have otherwise, because in a normal market, it would have been bid up with 20 offers. The price would be way higher than you were able to afford, and you just pull out because you can't compete, or someone comes in with all cash and you can't compete. So it gives you opportunities if you are, like you said, and this is the key word, prepared. And that is really a point that I'd love for your audience to understand, is the people that win in any type of market are the ones that are the most prepared. And it takes some time and due diligence, but this is the biggest financial investment. My guess is for 99% of your audience. For my audience, it's at least 95%. And people don't really look at it that way, and they don't do the prep work on it, because if they do, their expectations are realized. They don't have buyer's remorse a month after they buy a new house when that new paint smell wears off and they're still stuck with the mortgage for 29 and a half years, that they're still happy with their decision. It is very easy to impulse buy a house. It really is. And I know that sounds weird, but it is. And my priority is not for a client to actually get a home. It's to make sure a client understands exactly what price and what payment they're going to be looking at so that they only buy a house that they can afford. Not that they qualify for, that's another story, but what they actually can afford.
Well, that makes a lot of sense. And I think you're absolutely right that would hit the majority of people listening to this show right now. So that's, if you are listening now, why don't you rewind about the last 30 seconds and just listen to what Jesse had to say again. But before we get any further, Jesse, why don't we get into your first alarm? That sound good?
Sound good? Yep.
Awesome. So on the fire department, your first alarm assignment would be 4 engines and a truck. But here at the Firehouse, we'll ask you 4 questions and you give us 1 piece of advice. So with that being said, you're first in. So why don't you tell us who you are, where you work, and how long you've been doing it?
Sounds good. So I'm Jesse Tenenbaum. I'm a senior loan advisor for Guild Mortgage Company. Guild Mortgage is privately owned. We're headquartered in San Diego. It's a massive company. It's in all 50 states. We just happened to get started here in 1954. There was a builder called Martin Gleisch. He was the founder of our company, and he started a company because he was frustrated with the lenders that he would use for his subdivisions. So it started with one, and it got built and manifested into the beast it is today. Guild is still privately owned, but we do about $18 billion a year in mortgages. So we are a top 10 lender. It allows me the flexibility to offer great programs, great interest rates, but still retain control of the entire process, start to finish. A lot of big banks and a lot of credit unions, they use, corporate, centers that do all their operations that are in the middle of nowhere. And it makes it incredibly difficult to do a loan. So everyone that touches the file from start to finish is under my roof. So it gives us, the big brand that we need, but also the small feel to make sure the experience for our clients is top notch.
That's awesome. And we try to, there's a big parallel right there with what we do here at the San Diego Fire Department. Is we are a big outfit, but we also really strive to provide that little extra level of customer service that people remember. And it sounds like that's what you guys are doing there at Guild too. With that in mind, what do first responders need to know about lending, or what are some things that would make your job a lot easier if a first responder came into your office looking for a loan?
Yeah, I mean, if I had a wish, it'd be that everybody looking to buy a home called me and had a 30-minute conversation first. Because, my industry, just like realtors, and this is unfortunate, but it's true, I would say about 90% of both of our industry are not very good at what they do. And it really is a shame, but that is the truth. Because the people that prepare and the people that get the advice up front are usually the ones that win. And my job is to advise. It's to look at your holistic financial situation at the point of considering a mortgage and giving you quality advice around it and matching a loan product that meets your goals. How much do you want to pay out of pocket every single month? You're going to write a check for 30 years. You better have control over what it's going to be. And how much do you have to play with out of pocket? Usually with those two numbers, we're able to determine loan products that are available. But what I want to make sure first responders, police officers, firemen, nurses, doctors, anyone in that field, there's specific loan programs that are not heavily advertised that are built for you. And really getting an understanding about what the goals are and what your constraints are helps me determine what box you ultimately want to go in. So what I like to do is get all those goals, do all the logistics of a pre-approval, just so I know you qualify for these programs, but then present them all side by side. This is what it's going to cost out of pocket. This is what it's going to cost per month. And this is how we compare the loans. I've found that a lot of firemen, as an example, they're analytical thinkers. And they're from the gut, they really like to make a decision. But once the data is actually kind of accumulated for them. And if you are someone doing this research on Google, you're not going to have enough experience and knowledge to really make that determination. So my first suggestion is, it's a principle of modeling. Find someone that had an outcome you look for and try to copy it. And what that means in real estate is make sure you are referred into a realtor and to a loan officer that is good and takes care of their clients, and really vet that process, because it's super important. Rate is absolutely important. We all want to have the lowest rate, but it's important to have the right team working for you in addition, because real estate, it's a separate beast, and it's not only being approved, but it's actually getting a property tied down. And that is an involved process. And if you have professionals that work for you that are really good at it, it increases the chances of a perfect outcome. So
Yeah,
it's just,
absolutely. And I think part of what you're talking about and what we talk about here at the Firehouse is number one, success leaves clues. So you mentioned if you have somebody that can kind of guide you down the right path, it just flattens your learning curve a lot. And if you have, especially if you have somebody that can kind of open doors for you and introduce you to other rock stars in the industry, then you've already sort of kicked your foot, or you kind of kicked the door open a little bit and have really eliminated some of the barriers to entry. And what we talk about is forming your team, right? Getting a great real estate agent, getting a great lender. And if it's going to be a rental property, you might need a property manager, and then you're certainly going to need a contractor or a handyman to help manage your asset. And I think when you frame it in terms of thinking about building a team, those are for me, the four most important players. And of course, talking with you, it sounds like that's something that you think about as well.
yeah. And you want someone to challenge you and to advise you and not just be an order taker. Because, let's say, for example, a very common first-time homebuyer loan is called FHA, the Federal Housing Administration, one of the most common products. Some people will call a loan officer and say, hey, I want an FHA loan. And that loan officer will say, great, apply here. Can't wait to work with you.
And can you
they don't.
What an FHA loan is for somebody that just doesn't
Absolutely. Know? So the FHA loan is a government insured loan. And it allows, because the government is essentially guaranteeing it, it allows lower FICO scores to qualify. And it allows for a 3.5% down payment, one of the lowest down payment loans out there. It's a good program if you don't qualify for a better one, but it is not the best one out there. And
because of PMI or what is that?
Yeah, PMI is not a bad thing. Under 20%, you're going to have PMI in some respect, but FHA's PMI stays on the loan forever until you refinance it to a conventional or until you sell it. And that wasn't always the case. This was about 8 years ago, this changed. And ever since that FHA, the mortgage insurance is permanent, it's not as good of a product because you have to assume moving forward, we're going to see rates rising eventually. And if you got into an FHA mortgage today with the expectation of refinancing down the road, you might see no benefit. So you're going to be in that higher payment for a longer period of time. So this is the preparation, right? If someone has a FICO score that only qualifies for FHA and they just found their house, they have to use that program. If we talk well before you look for a house and there's an opportunity to repair your credit and to help get to a credit score that's going to be a better rate and program, that's part of the preparation work. You're not being reactive, you're being proactive.
Absolutely.
So, and if this is the right time, I'd be happy to tell you my favorite loan products for your audience, if this is the right one. Okay. So I know there's a lot of firefighters that have military experience. VA loans undoubtedly is the best loan product available if you qualify for it. It's 0% out of pocket. It's the lowest rate you can get, and there's no mortgage insurance on it. So it's a phenomenal program, and it's meant for people that have served. You can't get any better than that. Outside of that, one of the programs that is not really advertised heavily to you guys, and I think it's a big disservice, is the Golden State Finance Authority. Golden State Finance Authority is a government-run program that offers, I'm going to call it a second mortgage for these purposes. And that second mortgage is your down payment and it's your closing costs, so that you truly are coming to the table with zero. The best part of this program is if you are a first responder, if you are a nurse, a doctor, a firefighter, a cop, that second mortgage, that gift, is actually a gift. You do not have to pay it back. So this program exists for everyone, and it's a 7% credit towards your closing costs and down payment. But if it's someone like me getting it, that 7% becomes a second mortgage. For someone who is a firefighter, that 7% is forgiven immediately. So
is that only for primary residence, or is that just for your first home? Or
that is for primary residence. So VA, FHA, and that program are all for first-time home buyers, which essentially means you don't have ownership in another property for at least a couple of years that you've actually lived in. So when you're starting to talk about buying a house as a second home or an investment, you're not going to be looking at VA, FHA, or this program, GSFA. Those programs don't exist for investors.
Okay. And so kind of pivoting into the real estate investing world, if let's say I built up a lot of equity in my primary residence and I wanted to put that equity to work, right? We talk about not allowing lazy equity to just sit around doing nothing. What are some products that are available that I could put that equity to work? Something like a cash out refi or a HELOC, for example.
Yeah, cash out refinance, it's a really good tool to access equity. And right now it's a really unique time in history for that because rates are so low. So I'm doing a loan for a client who's a really good friend of mine in Los Angeles. He has so much equity in his home, but his other assets are really minimal. So he decided to access the equity in his home and use those proceeds to time his investments into the stock market, anticipating some sort of a correction this year. So he's accessing the cash and choosing his investment vehicle as the stock market, but just as easily, you can use those proceeds to go and buy another piece of real estate and add to your portfolio. And, again, this is something where you really want to customize the conversation, because my favorite form of multiple property acquisition over the course of time is just to continually buy your new primary residence, depart your old one, and rent that one out. And the difference is when you have a primary, you live in it for a year, then you decide to leave and buy something new, you get to immediately use the rental income from that property to qualify for the next purchase. And the rules of being a first-time home buyer, lower down payment, FHA, VA, conventional, those loans are all back to work with. So you're not going to have to put the 20% down to buy an investment property with a higher interest rate. You buy the next property you're going to live in for 1 or 2 more years and continue that process. It's going to lead to the best outcome, and it's going to require the least amount of cash.
Got it. That makes a lot of sense. And just going back to the difference between a cash out refi and a HELOC, there are some intricacies there that people need to be aware of.
The most common negative of a home equity line of credit is that it's an adjustable rate mortgage. The exceptions to that are if you have a ton of equity in your home. Like I know some lenders like a Wells or a Chase that might give you a fixed rate if you're only accessing a maximum of 60% of the equity in your home, including whatever first mortgage you have. So it's not a big audience that can get that specific niche. Right. The rest of them, which is the vast majority of home equity lines of credit, are adjustable, and they can adjust every single month. So there's 2 components to it. There is the index, which is what it's tied to, like LIBOR, prime interest rate, things like that. And then there's a margin, which is basically you take that index and you add a certain margin on top of it. That's your rate. So if it was the prime interest rate and a margin of 2, you're likely going to be close to 4.5%, 5% on those monies today. But if the prime rate goes up 1% next month, that rate can adjust 1% that month. So I'm not a big fan of HELOC for long-term debt. I'm a big fan of HELOCs for security and short-term debt. Okay. So the difference is, let's say you need $50,000. If you do a cash out refinance, you're going to have 1 mortgage, 1 fixed rate, and you pay it back over 30 years. You get all the money up front in 1 lump sum. You can spend it, you can save it, you can do what you want. Mm-hmm. For a home equity line of credit, it is simply that. It's a line of credit. So on day 1, you have a $50,000, credit card, essentially. If you use 0 on it, you don't have a payment that month. If you charge $2,000 on it and pay it off within the month, you don't have an interest charge on it. So it's a really good tool to get access because your rate's so much smaller than a personal line of credit. It's smaller than a cash advance on your credit card, and it's much cheaper long-term than liquidating any of your assets that are invested. So I'm a big fan of having one because it offers that security line and you can draw on it for 10 years. After the 10 years, they freeze it. You have 20 years to pay it back, or you apply to do a new home equity line of credit. So it's a really good tool, but it needs to be used the right way. And the biggest thing is you need to know what the risk looks like. You need to model worst case scenarios on the prime interest rate. What if it goes up 5% in a year? Will I be able to afford that payment? If the answer is no, you want to be very careful about utilizing that as a tool. So again, this all goes down to goals and preparation.
Yeah, and that's gonna ring really true for all first responders. Is we are in the business of risk mitigation and always trying to limit our downside. And so, understanding what these products what they do and what they can potentially, where they can potentially harm you is something that's really important there. So I guess with the cash out refi, that's more for a longer term play, but is there a crossing point in your mind, Jesse, where it doesn't make sense to go back and cash out the equity? Let's say you've been paying down your mortgage for X number of years and now you're really knocking down some of that principal. Does it get to a point where it doesn't make sense to cash out?
Again, it depends on your goals. But as an example, most people think that when you do a refinance, you reset the term. And while some banks, that's absolutely true, a lot of banks, that's not. Like a Guild mortgage, you can set the exact number of months that you want. So if you want to be able to access equity but not lose time, and you have 22 years left on your mortgage, you can do a 22-year mortgage with me today. So you don't always have to give up. But you have to know a 22-year mortgage versus a 30 is a much different payment. And if you can afford it, great. But the unique opportunity right now is most people's rates are above 3.5% in general. And if you can get a cash out refinance and reduce your rate and payment, that is not free money, but it's pretty close to it. Like I have clients that are pulling out 50 to 75,000 right now, and their payment is not changing 1 cent. So for them not feeling any financial pain, they're getting the kitchen, the bathroom, things that when you invest money into have a 3-to-1 multiple on your value. You know, don't spend this on a pool. You get 1 for 1 when you buy a pool. Only buy a pool if you love it, or a truck. But those kitchens and bathrooms, as an example, is a phenomenal place to add equity.
Absolutely. And that you either add it to your primary, or you can maybe even take that chunk and go try to invest it in a rental property.
That's right.
Yeah. No, what a powerful tool. And that is what I really love about real estate, is that you can use all these mechanisms of leverage to accelerate your wealth building, where for me in the stock market, I don't see that happening as much.
Yeah, and I have my own take on that. And I'd love to elaborate a little more, but you're right. You know, real estate is my first favorite investment because it's leveraged, like you said. If you have $50,000 and you can put 10% down, you bought a $500,000 property. If that property goes up 10%, which is likely, you just made 100% on your cash. Your 50,000 turned into 50,000 equity. If you buy, 50,000 worth of Apple stock and it goes up 10%, you just made 5,000. And when they allowed you to buy stock like you bought a home, back when the margin days of the Great Depression, that's what caused it. People were putting 10% down on their stock, and it doesn't work in a digital stock market. It works when there's a fixed asset like real estate. So first and foremost, the primary residence, because you get the tax breaks off the interest, and because the low down payment and the leverage investment, it's my first favorite place for people to invest money.
Yeah, no, that's perfect. And I love what you said about being able to deduct that interest. Is it possible, number one, is it possible to get a HELOC on an investment property? And if it is, I don't think that you can deduct that interest. Is that right?
You can't even deduct your interest on a HELOC on your primary anymore. Okay. It's only your first mortgage on your primary residence. HELOCs exist for investment properties. They're not too common, so they're very expensive, and you need to have a lot of equity in your home. But the primary is the better deal always.
Okay. Yeah, no, that makes sense. So moving on, where do you see things going? I know that interest rates are at all-time lows, historic lows. If you have the opportunity to lock in that long-term financing, now is absolutely a great time to do it. So where do you see things going in the sort of the short, medium, and long term from here?
Yeah, I mean, it's hard. I think people that try to time the market mostly fail. So I always like to look at the current snapshot. Is it saving you money? What is the catch up on your investment? If your closing costs are, let's say, $4,000 and you're saving $40 a month, that doesn't really make sense. It's gonna take way too long to catch up on that investment. So you got to be careful about that. Where I think the market is going, I personally think the stock market is way overinflated right now. I don't think we should be at 24, 26,000 when we have negative GDP and we have all these issues. So I personally think there's going to be a correction. And if there's a correction in the stock market, that means we might have lower interest rates. So I never thought I'd say this, but I'm advising clients right now who are at a 3.5 or 3.375 not to lock at 3%, because they're in such a low rate that they can stomach a little bit more risk, even if they never accomplish a refinance. 3.5% in the grand scheme of things is an unbelievable rate. But
Right.
the prospect of getting to 2.75, it could be there. It really could be in that situation. It could even be lower. So this is more specific to the person. If you're in a 4.5% rate or a 4, and you can lock 3 today, do it. Because if it goes up, you miss the boat so much, you're not able to participate in any of it. If you get a 3 and then historic lows become 2.75, I really don't think you're going to have trouble sleeping at night.
Right.
I think you'll have trouble sleeping at night if rates go back up to 4 and you lost the opportunity altogether.
No, absolutely. And what I try to remind people of, just to keep perspective, is these numbers are definitely doable. If the people that have been investing in real estate, sort of our parents' generation, they were doing it at twice the amount of interest. And I feel like, if they were able to do it, then we should definitely be able to make it work.
In the Carter days, it was 17%.
That's just incredible. That's
Yeah.
just incredible. So that's cool. Well, I guess with that, Jesse, you got knocked down on your first alarm.
Love it.
So where can people find out more about you?
So my website, jessetenenbaum.com, always the easiest. It has all my information. And I really applaud people that seek education and preparation, because it's really rare. So I just want to give that open invitation, because I don't want people to think if they call me, it's because they want to buy tomorrow. I have clients that want to buy 5 years down the road. It doesn't matter. Having the conversation up front and getting better prepared, it's like stepping on a scale. You need to know what your temperature is. You need to know where you are today to know where you want to go tomorrow. And the most common thing that people say leaving my office, or these days a Zoom call, is wow. Like they were impressed because they had some sort of barrier in their mind that once they voiced it, it really wasn't an objection. It was something I most commonly get: are we even allowed to buy with less than 20% down? I heard there's no ways to avoid mortgage insurance, with less than 20% down, and things like that. And once you give them a little education and you show them the scary thing, which is the numbers, what it's going to cost and what it's going to cost out of pocket, the 2 checks you're going to write, it becomes a lot less scary. Yeah. And then the fun part of actually searching for a home, which is the emotional aspect, that process becomes better, because you're not just blindly looking at a house that looks really good on paper, but you have no idea what that monthly payment's going to be, and you're writing an offer on it. Right. So it just, the more that you prepare and the more you seek the education and counsel early, the better you're going to have in the experience start to finish. And you're going to win more when you do that.
Yeah, no, 100%. And that's exactly why the FIREhouse exists, is for that piece right there, is just to get the education out there so people can be armed with something to go out and take action on it, right? It's not enough just to have the information, but then you have to go out and act on it. But without having access to the right people, the right information, then you're fighting a real uphill battle. And one final thing I want to just say is real estate moves slowly, and there may feel like this real push to, you got to lock something in right away. But I did love the piece you're talking about. If you're just talking about slicing off a little 0.25% here or there, it might not make sense. But get yourself educated, be patient, and some really good things could be in the future. So I love it.
Absolutely. Yeah, it's all about preparation. I know I keep saying that over and over again, but repetition is the mother of skill. And it's important to me that the audience realizes that. I educate all my clients when they're open to it about a personal family budget. And I know that's weird in the context of a mortgage. I'm getting you approved to buy a house, but I think it's a responsibility to have that conversation, because there's no education around that, no formal education around that. And people, have their own systems. And I thought I was really good with money. But I'm in a business coaching group. Casey's familiar with it, and it's for real estate agents and loan officers. So someone's been looking at my personal budget for 10 years. And I thought I was doing a lot of right things, but there's best practices that have been established since the dawn of time, like you said, model behavior. And I just get such a kick well beyond qualifying you for a mortgage. I get really the more benefit to me is when I can show someone how to properly manage their money. Not tell you what to invest in, that's not my business, but how to manage it, and how to, be transparent between the two spouses, and how to, tactically look at your money instead of emotionally look at it. It's a completely different perspective.
Yeah, and that's fantastic. And I think that if somebody like you in your line of work is still committed to budgeting and to really digging into your finances on a regular basis, that's something that we can take. That's just perfect advice for people in our position who may be just trying to get started on their path to financial literacy, financial independence. Is you have to be intentional in this stuff, and you have to pay attention.
Yeah, and I mean, if you indulge me, I'll give you the kind of steps that I recommend for my clients in terms of order. So first and foremost, pay off all your revolving debt. It's where you need to go first. If you're paying 12, 15% on a credit card, why are you even looking at real estate? Why are you looking at any investment? It's the lowest hanging fruit. So get rid of the debt first. Second is build a reserve account of 3 months of what you need to survive. And that is so when the inevitable surprise happens, these shouldn't be surprises. They really occur so frequently, it shouldn't be called something different. But when those surprises happen, you now have cash as the tool as opposed to the credit card. So you're not just going through this cycle of charging, paying off, charging, paying off.
That's in the Dave Ramsey camp of
exactly. After you get that taken care of, you buy the house because it's a leveraged investment. When you're done with that, my money goes into your retirement accounts. So just to play a game, if you invested into your, what's the retirement program called for you guys?
For us, we would either have a pension for some of us, some have a 401k, some have a 457.
So as a 401k, because it's equivalent to me, if I put $1,000 into my 401k and it's invested and the stock market has a 0% rate of return, what did I just make on my money?
Right.
About 30%. And people don't realize that. You make 30% on every dollar you invest in your retirement account because it's pre-tax. So if the stock market does 0, you've already made 30%. If your company matches a certain portion, you can make up to 60% before the stock market does anything. And by the way, the stock market had an amazing year last year. So, people need to go where their tax benefits are because there's not a lot of them. And that would need to be taken advantage of first. So it's the house because it's leverage and you get the write-off. Then I like the 401k next because it's pre-tax dollars. After that, I like a simple asset allocation strategy. I'm a simple guy. I don't like to make things complicated. When Warren Buffett dies, he's putting all of his money into a very specific allocation, 90% into an S&P index fund, 10% into short-term intermediate bonds. If it's good enough for Buffett, it's good enough for me. And I just know I'm young, so I like to have some play around money. 10% of my money, so it goes 80% into the S&P, 10% into bonds, 10% I choose my 6 favorite stocks that I'm never going to sell ever. So, I love Amazon, I love Tesla, I love Apple, I love Costco, I love Wells Fargo. These are things that I use. So that's what I've been taught in terms of investments, and I haven't deviated from it. And I'll tell you, it takes so much of that guesswork away. It takes so much of the comparing yourself to your friend that talks about his one stock trade that he did 5 years ago, and you think like you're not getting your rate of return. The S&P index has returned 10% a year on average. That is enough for your money to double every 7 years. I mean, it's just the slow and steady, and albeit boring approach is what wins. So if you're looking for the gamble, you got to look internally because money should not really feel like that. It should feel very boring and tactical, and you're just executing a plan month in and month out for 20 or 30 years. And if you do that, you will have enough to retire and live a great life.
Yeah, no, that's perfect. And I see a parallel between where you even mentioned it early on about not trying to time where you're locking in an interest rate. And don't try to time when you're jumping in and out of the stock market. That if it was easy to do, then everybody would. And there's a reason we know who Warren Buffett is, because he's one of the only people in history that has ever consistently been able to get these returns. And I think it's a really important point you made, that even he is just going to do a simple, boring 90% S&P and then 10% bonds when he passes away. That should pretty much sum it up for everybody.
Yes, and there's so many books out there that do not give great information. That's why seeking the right education is really important. Mutual funds outside your 401k you have to, but mutual fund managers, they do not outperform the stock market index like I just talked about. There's 4% that do, and the 4% that do are not the same 4% every year. So they're just people that are just getting lucky. And the technology that these firms pay to make these small trades between these tenths of seconds, we don't have access to that. I mean, for us, we have to be consistent. We have to be tried and true. and we just have to invest over a longer period of time and be really smart with our money. And don't worry about the rest. I mean, the percentage of Americans that save zero is so high that if you are just saving a little bit, you're buying a house, you're putting 5 or 6 grand away in your 401k every year, you're getting it matched over time, that is enough. And you just have to start early enough and be consistent enough, and be, brave enough to really get a temperature gauge every now and then of where you sit, step on the scale,
Yeah, no, absolutely. And if I could put you on the spot, if you had to send somebody, if you had to direct somebody to one book that's sort of helped you understand some of this stuff more fundamentally, what would that book be?
Tony Robbins' Money. So Tony Robbins' Money, Master the Game. The first 3 or 4 chapters is him giving you a brief summary of every asset allocation, every type of investment vehicle that exists. Awesome summary. It really, really is powerful. The second half of the book, he interviews like 6 or 8 of the best investors in the world, and he asks them a simple question. If you could not give any money to your heirs, but you can only give them an asset allocation strategy, what would it be? So you hear from Dave Swinton, who runs Yale. Yale's fund went from 1 billion to like 35 billion under his management. You hear from Ray Dalio, who runs the biggest hedge fund. He doesn't do it anymore. He's graduated from it, but Ray Dalio, the CEO of JP Morgan Chase, T. Boone Pickens, like you hear incredible advice from these people, and you basically look at each of the asset allocations and you figure out what gets you going, because all of them are going to win. They're just different because they have different philosophies. And then you kind of pick which one works for you, and you kind of, be as involved or not involved as you want. But it's by far the best money I've ever read on investing, because it takes what I think, which is everyone's out to get me. These mutual fund managers are BS. It's all just mass marketed stuff to get my 401k or my investments. And he tells you you're absolutely right. Most of them are crooks. Most of them have high fees. Most of them, it's all a marketing play. And because he kind of volunteers that, the trust you have with him as an author is really high. And then again, you hear from the best investors in the world what they would do if they couldn't pass their money on to their clients, but literally what their asset allocation is. So, I went back and forth on 2 or 3 of my favorites for a long time, and I decided on a little bit of a hybrid. But the Warren Buffett with a little bit of personal stock picking was the most appealing to me. It's super simple. It's easy. It allows me a little bit of mitigated gambling, so I can have that part of my brain satisfied.
Right.
But long term, I know if I'm tried and true, I'm going to have what I need at retirement to retire. And will I retire? Maybe not. It's not like I want to, but being in a position to retire is a completely different position. And that's what we're all trying to get to.
Yeah, no, exactly. When we talk about financial independence, it's not that you're going to stop working, but now you're working because you really enjoy it. And what was interesting to me was hearing you say that personal finance is just that, it's personal, and where you don't always recognize Tony Robbins as somebody that is very financially savvy. You kind of, I associate him with somebody in the more personal development sphere, but he's consistently producing just some outstanding books, and that's one that I have heard a lot about as well.
Yeah, and I mean, you said earlier, success leaves clues. That's one of his mantras. He has best practices because he's modeled his entire life. And the finance side, he actually wasn't that involved with for most of his career. But he realized over time how impactful it is and how much of a benefit and how little it's talked about. So he spent 2 or 3 years interviewing amazing people, like 4 or 5 hour interviews. And that's what he used as the basis to compile this book. So there's a shortened version of it called Unshakable, because the money, it's a big book. It's like 600-700 pages. I don't think personally Unshakable does it justice. I'd highly recommend, listening to it. It takes about 24 hours to listen to. It's a long book, but reading it slowly but surely, because I've never had a better crash course in the education. And then it leads you to find like little, celebrities within the financial world and study them. So it got me to study Warren Buffett and Warren Buffett's advisor, Ben Graham. And it just kind of takes you and you see all these perspectives. But I'll tell you, a lot of reading has gotten me to the point where I'm not nearly smart enough or capable enough to be a Buffett. So just do the little stuff he recommends, and just watch your money grow over time. and just, be conscious of it, save money every month, give money every month, because what you give comes back in so many different ways, and make it a game. In a year, there's 12 months. So you have 12 opportunities to either win and hit your savings goal or lose. And if you win 9 out of 12 every year, you are going to be great. I mean, that really is what it takes. You're still allowed to lose a few months, Christmas time, things like that, where it gets expensive, but you're still allowed to lose a few months and you still will be fine. But people that ignore it, they get into debt, they get into a property they can't afford, they buy a car with a $1,300 payment when their current rent is $1,100. These are things I see over and over and over again, and it's just wasted money, because the opportunity cost of that money long term, it's huge.
Yep. No, absolutely. And especially when it comes to a car or something, you're buying a depreciating asset right out of the gate. Whereas with real estate, it's something that's going to appreciate.
And it's very common for VA loans. I see it most commonly for military, because they have the BAH, the BAS. I see so many, an $800 motorcycle and a $1,000 car, and they're literally renting for $1,000 a month, and now they want to buy a house. Yeah. And I have the conversation all the time, like, dude, trade it in, sell it. You don't need it. Invest it, do something to the house, buy a bigger house where you can actually write it off versus a depreciating asset. And, sometimes it's just because they're around other people like that. Yeah. So you need to widen your circle. You need to seek good counsel and advice, and execute, act. Don't be afraid, make that phone call.
Yeah, no, that's perfect. And maybe we wrap it up right there. So Jesse, I just want to say thank you again for taking time out to meet with me here. There's just so much information here to unpack. And this is probably going to be one of those shows that people are going to have to go back and listen to a couple times just to really let it sink in. And I hope that they do. So yeah, thanks again, man.
My pleasure, guys. And just a parting word, do not have any fear, hesitation to reach out to me. I've seen every FICO score imaginable. I've seen a 300 before. I've seen every financial situation possible, minus 10 million to positive 150 million in the bank. So there's nothing that shocks me anymore. There's nothing unique about your situation. I promise you. Seek counsel, seek advice. I'd love to have that conversation with anybody in your audience.
That's perfect. Thanks, Jesse.
My pleasure.
Well, thanks again to Jesse for meeting me here in the bullpen. It's always great to talk to experts in their industry. Wow. Thanks again, Jesse, for meeting me here in the bullpen. It's always great to talk to people who are just rock stars in their industry. People with that level of expertise are sure to save you thousands, if not tens of thousands, over the course of your investing career. But as he rightly points out, if you're not prepared, then you're just going to... Wow, thanks again to Jesse for meeting me here in the bullpen. It's always great to have people who are rock stars in their industry just talk about things that they... Wow, thanks again to Jesse for meeting me here in the bullpen. It's always good to talk to people who are rock stars in their industry. People with that level of expertise are sure to save you thousands, if not tens of thousands of dollars over the course of your investing career. But as he rightly points out, the ones who are prepared in any economic climate are the ones who are going to win. So don't get prepared now, just stay prepared. If you'd like to learn more about Jesse, you can find him on his website, jessetenenbaum.com. That's Jesse, Tenenbaum.com. If you'd like to learn more about us, we're on Facebook at The FIREhouse. That's f.i.r.ehouse. On Instagram, the _fire_house. On LinkedIn, The FIREhouse Investors, or anywhere you find podcasts. If you enjoyed this video and you'd like to learn more, please like, share, and subscribe. But no matter what you do, take this information, go out there, and get some. Station F.